Hello investors, bonjour. Today we're going to talk about a stock that is down about 40% for the past 12 months and that could be a great opportunity. And I've mentioned, no, that's not Starbucks. I've already done this video, right? It's another of my holding actually, and it is Disney. Dividend investors, bonjour. My name is Mike Yahoo, and I'm the founder of Dividend Stocks Rock, and I'm also a passionate investor. Every week, I do a video about the market, about some dividend-paying stocks, or I look at my own portfolio and give you some ideas about what's going on in my holdings. One of the rare company that I've decided to keep after a dividend suspension is Walt Disney, ticker DIS. So obviously today we're not going to talk about dividends because it was suspended during the pandemic, and after that they decided to forget about that part of the business and allocate their capital towards new business segment. It is important to understand that usually whenever a company cut its dividend or do a complete suspension as Disney did, I usually sell the stock and move on right away. Why I didn't do it in this case? Well, it wasn't exactly their fault that their business model involves having a lot of people at the same place, such as movie theaters, parks, cruises. And for that reason, I said, you know what? It was a thriving business before that. They were already working on their streaming services in 2019. So I thought it's probably a good idea to keep them in my portfolio. Unfortunately, Disney is down by more than 40% over the past 12 months. But when we look at the results, it's actually doing a lot better than it was last year. We're pretty much back into 2019 levels in terms of parks and cruises, which kind of tell me that going forward, we're going to continue to see that growth that was happening. So Disney is the emperor of content. They have all kind of characters, all kind of franchise. They have been actually changed from consumer sector towards communication because now they're almost like a media business after they acquire Fox assets. However, the big difference between classic communication companies that are just broadcasting movies or series is Disney is able to create multiple streams of income from the same franchise. So they have t-shirts, they have other apparels, they have figurines, they can create park teams. You know, Avatar is coming up at the end of the year. They already have a theme for Avatar in Florida, and they have created this possibility of not only having the streaming and making money out of like a series or a movie, but then people want to consume a little bit more of that Star Wars or Marvel narrative or Disney princess that has always been very popular. In 2021, when the pandemic was slowing down, stock price started to rise a lot because everybody fell in love with streaming services. So all the streamers like Netflix, Disney, even Amazon went with Prime, and all of them started to say this will be the new TV, and now our number of subscribers are growing and everybody fell in love for that narrative. Unfortunately, it's not the case in 2022, and this is one of the biggest problems that Disney has right now. Kind of funny because when you look at the number of paid subscribers, it keeps increasing every quarter. You have to be careful though. A lot of them, what you can see on this graph, Disney plus Hotstar, you have 50 million paid subscribers, but they don't even pay $1 per month. So obviously we're not talking about Netflix here making like maybe 15-20 bucks a subscribers. The average is more around $6 per subscribers, but the point is they're still growing their service, they're still attracting new viewers, and eventually they'll be able to increase their price. Actually, they already started that. If you look in their quarterly earnings from April, you will see that each time that I've circled that on that graph, every categories, the revenue increase. Why? Because they actually increase the retail pricing. They have a strong power there. They will be able to generate a lot more cash flow from this service moving forward. It's just a matter of time, but you can see that it's already happening. And while they increase their prices, the number of subscribers growth is still positive. So it tells us they create good content. They actually have an amazing library of content, and they have already mentioned that they want to invest billions of dollars every single year to generate more content and establish themselves. And they have kind of like a perfect advantage over a company like Netflix is their characters are already existing, they're already popular, and whenever they create a Star Wars or a Marvel series or a Disney series, people will want to subscribe and watch it. Now, I know there's a lot of politics going on with Disney. I'm not going to address that in this video simply because politics comes and goes. And to be honest, when my 10-year-old son wants to watch Obi-Wan Kenobi, he doesn't wonder like what's happening with the CEO, what's happening with the politics. He just wants to see a Star Wars series. And it's pretty much the same thing when when my daughter was younger. She was in love with Disney princesses, and that doesn't care like what the politics that was involved. Moving forward, this will continue. I'm pretty sure that if you look at everything that you buy, you're not making research to know like what the CEO says and what the company does. And most of the time, even though you're not in line with value in general, people will still continue to go through the park teams, and revenues and data is there to back this up. So this is why I think it's a big tempest, but I'm not going to look into it because for the long run, it's not going to have an impact on the business model. What is going to have an impact on the business model is that the business model is back. For 2022, you have an amazing lineup of movies, having 3 movies from Star Wars, so Doctor Strange, Thor, and Black Panther. So you can have like 3 very strong contender for top 1 box office already. And then at the end of the year, we're gonna have Avatar #2, which I don't know, we've been waiting for that for like the past 50 years or something like that, but it's finally coming. You can expect over $1 billion at box office for this one. Obviously, it's going to transport those numbers through 2023. And in 2023, we have even more Marvels, we have an Indiana Jones, and we have a Star Wars movie. For the next 2 years, we're going to see Disney getting its place back in the box office for the top 10. They will likely have 4 to 5 movies part of the top 10 of across the world. It's going to generate a lot of revenue from those movies, and then it will attract a lot of people to their park teams, and hopefully have some people that will subscribe to their streaming services, buy some t-shirts, and eventually generate even more cash flow for Disney. The place of Disney in my portfolio is a bit strange because it doesn't pay dividend anymore, and I don't think it's going to come back. I don't think it's going to come back anytime soon, maybe past 2025, but right now their focus is to build their streaming content, is to invest massively in that content. So we're talking about billions of cash flow, and when you think about it, they were paying, I think it was like close to $2 billion a year in dividend, if I remember correctly. So I don't have the numbers right now, but it's pretty much like it's over $1 billion a year. So instead of paying that to reward shareholders, they apply Finance 101. They take that money, they generate more value for shareholders for the long run. As you can see, the stock price is trading pretty much to 2020 pandemic level, which is kind of crazy when you think about it. Forward PE ratio is at 26, and when you look at the revenue, they're going back up. I'm pretty sure that next year, 2023, the revenue will continue to grow and will keep up on that pace, and then earnings is going to slowly come back as they slow down their investment. Overall, this one is obviously about growth. I didn't mind too much about the dividend because historically, Disney used to pay a 1% yield, paying their dividend twice a year. So it was not the end of the world anyway in my portfolio. But I really think that they have the tools and the growth vectors in place to be a thriving company moving forward. Just have to wait a little, but with their strong brand, they have a lot of pricing power. People don't mind to pay a little bit higher for their tickets to go to the park team, to go to the movie theaters, watch their movies, buy the apparels, buy the figurines for their sons and their daughter. So you don't really have to worry about this point. It's just a matter of being patient for this one. I'm still happy to have it in my portfolio. I wish it had a better ending, but I mean, you know what? 6 months ago, it was like trading close to $200. Everybody was super happy. Now it's fallen to almost $100. I'll be waiting. I don't really mind, and I'm definitely confident that moving forward, those characters will continue to generate a lot of cash flow, and then market will give Disney some love. So I hope that you have enjoyed the video. Let me know what you think about Disney, or what you think actually about companies that don't pay dividend and still is in a dividend portfolio. Obviously not my largest holding, but still it could be an interesting conversation. And don't forget to give me a thumbs up, subscribe to the channel to not miss my next video that will be published on next Thursday. And until this one, don't forget to stay invested.